Where's the music?
I don't know what just happened.
Duncan.
Duncan, are you okay? Did someone break into your lab and take you hostage?
All right, let's bring the heat. That was a low energy
So,
intro. My goodness.
wait, I'm sort of worried. He's not even responding. I sort of
Wait,
don't
can you
know.
hear me?
We could hear you.
There he is.
Huh. I heard the music.
No
I'll have to look into
problem.
it.
Check your email for a pink slip. Hey guys, welcome to an all-new edition of What Are Your Thoughts? As always, my co-host Michael Batnick and I will be bringing you our takes on the most important topics in the markets this week. We really love all of you who come here for the live. Wanted to say a couple of quick shout-outs before we get rocking. Chris Hayes, what's happening? John Carlo, Rachel, Doctor, Jay Luther is here. Someone's saying something about Josh Brown and where is this? I guess this is like a request for a guest.
What is
Cameron.
happening?
It's saying Cameron Dawson and Josh Brown, Beauty and the Beast. You will not call her that, sir. You will not. We will not do that on this channel. Who else is here? Cliff is in the house. Matthew's here. Jerry Gould. All right. Welcome to the show, guys. Such a pleasure to have you. Tonight's show is sponsored by our friends at Rocket Money. Michael,
my
what do we want to
favorites.
say about Rocket Money?
So I love Rocket Money. It is a great personal finance app that does a few things. It helps you find and cancel some of your unwanted subscriptions. If you're like, wait, I'm still paying for that? I thought I canceled it. Wrong. Rocket Money, you could cancel right from the app. One of my favorite features, large transaction detected. I get emails, large refund detected. Oh, what's this? What's this? I didn't charge that. Cancel. Boom. Done. I love it.
Rocket Money has over 5 million users, has saved a total of $500 million worth of canceled subscriptions. They've saved members up to $740 a year when they use all of the app's features. This is like real money.
Listen
This
to
is,
what else. Listen to what
It's
else.
a big deal.
So you know how every week, chart off. You know how every week you get a notification from Apple, screen time you've spent 6 hours on your screen.
Yeah.
You know what I get from Rocket Money? Here's
What
how
do you
much you
get?
spent. Here's how much you spent last week. This is higher or normal than average.
like Apple screen time. It'll
Yeah.
tell you like
Tells you
last
your spending
week.
by week. I love it.
Last week
Great
you were
app.
20% above your normal spending.
Great app.
Got it.
They do it
All
in
right,
dollars.
go
It's
to
great stuff.
rocketmoney.com/compound to try it out. Michael loves it. What more do you need to hear? This week, we're going to start with the everything rally. So one of my favorite technicians, Ari Wald at Oppenheimer, says basically it's time to position for the everything rally, and it's sort of already here. So what do we have? Let's throw up the first chart while I talk. The S&P 500 has reached a new cycle high last week. This is Ari, supported by 68% of New York Stock Exchange stocks above their 200-day moving average. This argues against the major top. While a broad-based breakaway hasn't developed in this bull cycle, constructive price action in the Russell 2 leads us to believe this breakaway should finally develop over the coming months. As a market signal, we remind investors that it's more important for small caps to participate in price terms than to lead relatively. So Ari's basically saying, look at the major S&P peaks in 1999, 2007, 2015, 2018, and 2022. They were all undermined by a falling 200-day participation rating below 60%. In this case, we're sort of approaching 70% participation. So that's why, in Ari's estimation, this market is not at all reminiscent of those prior market tops. And you can see on the bottom pane, we're showing you the percentage of New York Stock Exchange stocks that are above the 200-day. So I like that confirmation. I know you don't have to have it, but what are your thoughts? You think that's sort of important in your mind?
The market looks really good, but not overextended. If you look at like the percentage above or below the 200-day moving average, it's not like we're super stretched at all. In fact, put that chart back up. Look at the percentage of stocks above the 200-day relative to like the last cycle peak, right? They're well below. So not overheated, at least based on this chart.
I want to show you something about small caps, which Ari alluded to. So he's saying, next chart, guys. There's a difference between leadership and participation, and I think this distinction is important. Ari's saying, as a market signal, it's more important that small caps participate than be in front. Small caps don't have to lead. In terms of price action, this is Ari. We're encouraged by the Russell 2000. It's upheld its 200-day moving average while it attempts to break through 2-year resistance. We see this as a bullish change in character versus corrective periods in 2023. Relative to the S&P, we're unsure if small caps are more than a short-lived beta trade without an earlier staged economy. Here's one more thing on this. Large caps lead in real bull markets. So in January, Oppenheimer had published something showing that from 83 to 90, from 94 to 99, it's large cap outperformance. So do you need the Russell 2000 to confirm? Not really. Is it nice that it is? I think Ari's making the point, yeah, that's like good enough. What do you think about that idea?
Yeah, I don't think that like anything's set in stone here in terms of what small caps need to do. So there's been a tremendous rally for the last, 10 plus years, and small caps have underperformed almost the entire time.
Yeah.
In fact, if you look at
they get like 6 weeks.
so I'm looking at the IWM divided by SPY, and there's stretches where it rips, where the ratio rips. But if you look at it right now, it is at the lowest level since 2001. So IWM came out in 2000, and the chart went all the way up. In other words, from 2000 to call it 2011, small caps outperformed large caps a lot. So they went all the way up for that decade, that ratio, and it's rolled all the way back over. So it's been 12 years of the Russell trailing. Hasn't slowed down the market overall.
There are a lot of structural reasons for that, which we've gone into in the past. We don't have to rehash. Do you feel that the market is now getting close to overheating? Like, it's not a top, but is it getting close to overheating where we might be due for a meaningful pause? What are your thoughts?
Well, we just had one. So
is that meaningful? April down
4%. The 5% pullback. Listen,
Yeah.
are we stretched? Can we pull back? Yeah, sure, maybe. I don't know. Why not? But I think that the topic that we're going to cover later about analysts or sell side shops ratcheting their year-end target higher, accompanied with this, might send some signals that we need to pump the brakes and relax, and we might be getting ahead of ourselves.
Mike, you're talking about, are you subtweeting Mike Wilson?
Yeah.
What did he just do today?
Hold on.
Why is everyone talking about this guy?
We have a whole. Don't act like you don't know. We have a whole topic on that. So before we get
I heard
to
he
that,
raised his target, but I don't know why it's
sir,
notable.
we have a whole topic on that.
All right.
So I saw a chart from Todd Sonash Strategist that we stole and recreated and put a little bit of our flavor on it that I want to
Take that, Todd.
Yeah, take it. So chart on. Look at this. So what I want you to look at is the chart on the left shows the 1 year rolling return for the S&P 500. We are in the top decile of rolling 252-day periods, right? You see that on the right?
Yeah, what's the performance? Between 22% and 29% is the reason why we're in that.
That's the min, and don't worry about that. The important thing, though, is what are the forward 6-month returns? Pretty good. 5.5% on average with a 76% win rate. So the 76% looks like it's in line with in line with historical averages.
It's in line. Can I just say this out loud to make sure that I'm grasping this? So if you take all of the trailing 12-month S&P returns and you divide them into 10 deciles, we are in the second highest decile, like the second best decile. And what you're saying is going forward for the next 6 months, 76% of the time, you're still going higher in the market. And it's a return about 5.5% on average.
Yeah.
So
but
people
also
would think the opposite.
There's a big difference. Well, we wouldn't think that because we know better. There's a big difference between the second to best decile and the actual top. You know what I mean? Like, look at that run. I guess that's probably off the March 2020 lows. You know, just totally out of control. And it sustained that run for a while.
Wait, look how wide that barn door is. The best decile of trailing 12-month returns is minimum 29%, maximum 71%. Do you know how bad the market has to be to go up like 71% or more in any given year?
Yeah,
like
it
has to come out of a bear market.
It has to crash like 30% in 2 weeks. Well, that's what happened in March.
Right.
2020.
Right. Okay, so in other words, the message here is, yes, we've had an amazing trailing 12-month return up to this point. We're firmly in the second best decile you could possibly be in, but that does not necessarily mean the next 6 months have to be some sort of a give back.
I mean, I think that
that's a good message.
if your position or if your personality, and this is probably most people, because most people get like fearful when everything looks so good, it feels like it's too good to be true. But if that's been your posture for the last 15 years, you got destroyed. If you think that I'm bearish because everything looks so good, that's not how you make money.
Yeah.
Things look really good right now. They're not always going to look as good as they do today, of course, but I wouldn't fight it. Like that is not a winning mentality.
There's a personality type that feels as though it's almost like a religious, like if you're sexually promiscuous, like the God's about to punish you, or like it's almost like if you're having too much fun or things are going too well, there has to be some sort of a comeuppance. Like there has to be like you have to pay for it in some way. Like that's a mentality, and I find it more frequently with older people rather than younger people. But I understand it because the market really has been good, and it almost feels like we don't have to pay for this. Like we just get this.
Well, guess
So
what, dude?
I get that.
So do I. But from October all the way up to the prior peak in March, it was basically straight up. It was one of the best 3-month rallies that we've ever seen. If you fought that the whole way up, you know what you were rewarded with? Yeah, we got a 5% pullback. That's
So
what we got.
this is interesting. In the chat, I'm being told by Benjamin Lupu, yes, Josh, it comes from Protestant work ethic. Like in other words, you don't deserve 100% rally in the Nasdaq over the last couple of years. Like nobody deserves that. You didn't work for it, you didn't earn it. It just happened. Therefore, you're probably going to have to pay for it somehow.
You know how many AirPods I bought? I earned it.
We'll time out. So Thurman is saying that's Jewish guilt. I was going to comment back to Benjamin.
Dude,
This
not
sounds
time
more
out.
like
I'm
a
sorry. I
Catholic
love
thing.
I love the listeners, but they don't get to talk over me. I talk over you. So as far as
just pointing out, people get that instinct. That's all I'm saying.
No, it's intuitive. All right, so one more chart directly from Todd.
By the way, you get really triggered by referencing the viewers. Maybe we won't do this live anymore.
No, you know what? No, next week I will be reading the comments instead of listening to you, and we'll see how you like it. I'm sure you would love that knowing you.
I don't think you could multitask at the level that I do, but we could try it.
I definitely cannot. Okay. Todd sewn on. So it's not the everything rally. So this is the Goldman Sachs Liquid Most Short Index. And in fact, that's not true. I take it back. It is rallying. So the most shorted stocks have been rallying, but not nearly to the extent of what they did when things were out of control.
Yeah.
You know?
Oh, wow. Look at that. That was nuts. That's 2020 into 2021. I wonder what's in this piece of shit basket. It's got to be just
like a lot of
wall-to-wall garbage.
Like Roku is acting like trash.
Yeah.
Zoom hasn't gone anywhere. PayPal's still a dog. Are those
still the most shorted stocks though, or are
Peloton still looks like it's going to zero? There's still a lot of crappy stocks out there.
Yeah, no doubt about it.
All right. So here's what I wanted to say. Let's run through some chief strategists. Morgan Stanley, and this is Mike Wilson. It doesn't matter what we think, but what the market thinks, and it's clear that last week's data has given the markets more confidence in the soft landing Goldilocks outcome. Now, too clever person would say, the most bearish guy in Wall Street capitulated. And I understand that. I do. I get it. And I also get it because it's not just him. Here's another one. Deutsche Bank's Binky Chada boosted his year-end S&P 500 target from 5,100 to 5,500. You got another one from our boy Belsky. He lifted his target to 5,600. That's the highest on Wall Street. We believe the market is behaving in a similar fashion to 21 and 23. Years where we did not give enough credit to the strength of the market momentum, something we are trying to avoid this time around. So the analysts, the price targets are being ratcheted higher. And I hate to use the G word because we know that markets don't stay stable and good things don't last forever. That being said, things look good. Earnings are good. The consumer is good. The VIX is low. Spreads are tight. Inflation is cooling. People are making more money. Like, I don't know what the bear case is. Is the bear case is that there is no bear case? Okay, fine. If that's like your modus operandi, then good luck.
Yeah, look, this is not like a personal thing against Wilson, although I don't like the guy generally. But it's a really hard job. I don't think I could do it better than he could. But like, at a certain point, do you just stop? Like, do you just like?
I mean, that's his job.
No, but stop with the targets, maybe, or I don't know. I mean, he's not good at this, and it's not just because he's bearish, because he's been bearish and right before. But like, this is if you were saying in late 2022, after a really bad bear market, both for stocks and bonds, if you were saying like there's going to be another drop to 3,900, and then doubling down on it and lowering your target to 3,200, or having that be your extreme bear case, like the people that listen to you, 3,200 and then the market rallies to 5,600 is crazy. That's not being off by a little bit. That's like being very, very wrong for an appreciable length of time. So I just feel like just stop doing that. I don't know. Is it nuts to suggest that?
Well, was he not removed from that role?
But he's still doing this shit. I thought he was done. Why are we still hearing? Quote, and again, I'm stipulating this is hard. I don't think I could come up with a price target either. Okay, I just don't. The reality is that the S&P 500 is flat over the last 11 weeks and exactly in line with where we took off our tactical bullish call on December 5th. The main difference is that stocks are now significantly more expensive. He referred to the this is February of 23. He referred to the rally as pure FOMO. This is his words, not mine. This is pure FOMO at its best in our view, and we find all the hoopla and excitement about the year-to-date rally to be misplaced. Dude, earnings growth, not FOMO. And I found that at the time to be insulting. Like, oh yeah, everyone that's buying is an idiot except for you. Okay. So it's not personal. I don't love targets anyway. I don't really talk about them or focus on them that much. But like at a certain point, like this is not your thing, dude.
And he did cancel on us.
Well, that's why I don't like him. But I mean, it doesn't matter. He is the most notable capitulating bear. He put himself in that position, not me.
Well, if this were to be a top, certainly it would probably be noted than Mike Wilson top.
Oh, he's gonna regret canceling on me. I don't want it to be that way. I just feel like that's where this is going. All right. What are we doing after this? Because there's not a lot of signaling. Did we talk about the Deutsch guys target?
I just mentioned. I didn't read it.
5,500.
Mention.
They all seem to be clustering now between 55 and 5,600. That seems to be where the bulls are. I mean, it's hard even for the bulls. It's hard because you still have 6 months and change left in the year, and I guess the safest thing to do is to cluster around where everyone else is.
I would be tactically neutral right now, given the upcoming election and the summer.
I'm on record. I think the most obvious thing to predict this late summer into the election is chaos. And a lot of people would say, yeah, that's how you know it's not going to happen. Nah, I'm pretty sure it's going to happen. Like I'm pretty sure there's going to be some chaos.
Well, guess what? You know what happened today? The VIX closed at its lowest level since early 2020. Lowest close in the VIX since pre-pandemic, under 12. That's wild.
All right. Speaking of chaos, tomorrow Nvidia's earnings. It'll be after the bell. Are they a late reporter or an early reporter?
Late.
It's a late reporter. All right. Let me give you the estimates. Nvidia is supposed to quintuple their earnings versus the same quarter last year. So from that perspective, you kind of can understand why the stock has done what it's done. Not pure FOMO, it turns out. $5.58 in earnings, which would be a 412% year-over-year increase. This is unheard of for a company of this size. $24.6 billion is what's expected. That's only a 242% year-over-year increase. EBIT is expected to come in at $16.4 billion. Last quarter, it was $3 billion. The same quarter last year, rather. So that's a 437% jump in cash flow. The last time they reported was February. Earnings were $5.16 versus $4.64 expected. They beat on revenue also. The stock went up 16.4% in response to earnings, added $276 billion in market cap that day. So we have seen Michael Jordan-esque moves around earnings from this company several times in the last couple of years. Not every time, but there is a universe where this thing prints 1,100 after the earnings. Like nobody should act like that's impossible. And if you think it's impossible, I want you to close your eyes and think about this as a $95 stock, not a $950 stock. And you know damn well any $95 stock can go to 110 at any time. So, there is a universe where that happens. Not my prediction. I'll be happy if it does. And if it does, it's going to be really tough to have price target of 4,400 on the S&P or whatever.
Josh, do you remember all the way back 30 days ago when Taiwan Semi, I think, warned that Nvidia fell 20% in like 3 weeks?
When was that?
3 weeks. It was at the end of April. Guess what happened today? Nvidia closed at an all-time high.
Yeah. I mean,
we got some charts.
You know how hard it is to be an active growth manager and fight against this thing, being like significantly underweight this stock. What do you tell people? Like I'm protecting you. What are you protecting me from? You know what I mean? Dude, this is so hard. Tell me what's in the chart.
This is the cumulative 12-month forward earnings revisions. And if you ask me to explain what that means, honestly, not sure I could do it. But be that as it may.
Cumulative 12-month forward earnings revisions. It's showing what the analysts are doing.
Is it showing how far behind they were?
No, it's de facto
right?
it is. But the purpose of the exercise is to show that as the stock has gone up, it's happened in concert. It's not FOMO. It's earnings estimates going up in concert with the share price. And Chart Kid Matt's take is that means the increase in the share price has been fundamentally driven.
Well, we know
it's
it
not
has.
multiple expansion.
No, it's the opposite. It's contraction.
I mean, it's super impressive. I don't know that you could say we didn't do this research, but I don't know that you could say any of the mega cap tech have that same have such a perfect matchup between the cumulative analyst expectations going higher in concert with their share price. I'm thinking Amazon does. I don't think you're going to see that with Microsoft or Apple. I mean, this is like pretty pristine. So, all Nvidia has to do is quintuple their earnings every quarter, and it'll be fine.
Yeah, I agree. All right, we got 3 more good charts.
What is this?
This is yours, no?
Yeah.
So Nvidia has doubled the performance over the last. What are we looking at here?
Nvidia is up. So this is going back. This is going back to the end of 23. So Nvidia is up 90%, and the VanEck Semiconductor ETF SMH is up 43%. So it's a full double over its peer group of companies, which I guess should not be that surprising because most of the companies in that index are not growing anywhere near where Nvidia is growing. So this is what it should look like.
We're about halfway through the year. Nvidia is up 92% for the year.
What's this? What's his tweet?
2 more. All right. Nvidia, this is from Mike Sicardi. He tweeted from Bank of America. Nvidia drove 37%. Chart back on, please. Nvidia drove 37% of S&P earnings growth over the last 12 months.
That's
and
crazy.
11% of the return. But is expected to drive just 9% over the next 12 months. So
what does that mean?
I think that this is a combination of Nvidia's growth perhaps slowing, but the rest of the market picking up the pace.
Yeah, well, we've said it before, and this is one of my core beliefs about 23, is that the number one thing the Bears got wrong had nothing to do with macro.
Yeah, that's a good point.
They got the earnings wrong, and if they were dismissing ChatGPT and GPUs and the AI revolution, then they missed 37% of the S&P's earnings growth coming from one company.
Wild.
That ended up becoming a gigantic index weight.
Wild. I wonder if that's ever happened. 37% of the earnings growth over a 12-month period come from one stock? That sounds insane.
I have to guess the answer is no. The only thing I can think of is potentially Cisco became the biggest market cap in the world. because it's not just enough to have a fast-growing company. It has to be so big, the company, in order to be that heavily weighted in the earnings growth equation.
And it also happened at a time where I think that earnings year over year for the S&P were probably flattish. So this like stood out even that much more so. You know?
Yeah.
What's the chat saying?
Nothing. I'm looking at the next chart. This
All
is
right,
nuts
this
too.
is great. So another one from Chart Kid showing that
There's a lot going on in this.
I got it. The earnings report from Nvidia has market implications, or at least it has over the last few years. So what this is showing is that the average 5-day return, now it's short term, of course, the average 5-day return for the S&P 500 after Nvidia misses is down a tiny bit, down 9 basis points, NBD. But the average 5-day return for the S&P 500 after Nvidia beats is 0.6%. That's a massive, massive spread. So in the short term, it's been important.
Yeah. So this answers the question, like, does the market need Nvidia's earnings to be good? Like the report, the report itself.
Well, how about this?
Need is a strong word, but it definitely helps.
How about this? If Nvidia bombs, which it hasn't done yet, and the stock, not the company, because we know the company's going to beat. We just don't know the magnitude of the beat. If the stock falls 30%, risk appetite will change pretty quickly.
I think that's right, because I think it's a bellwether. Not that there are so many other companies that do what they do. It's not a bellwether in that sense where you would say like Walmart is a bellwether for consumer retail, right? It's not a bellwether in that sense.
It's the narrative.
It's the narrative and the transformation of the economy into an AI economy. Nvidia is the shot caller from that respect.
Speaking of narratives, I want to read a tweet from Chris Sidiel that I thought was not provocative, but just common sense and interesting. And Chris is
I like Chris.
A vol derivatives trader, really smart kid. He said, this is going to be a controversial take, and I'm sure it's going to upset some folks. However, the more equities shrug off hot inflation data, and excuse me, this is a week old. The more equities shrug off hot inflation data, the more affirmation there is towards the dying narrative. If you've been trading for a while, you've seen narratives get cycled out of the market and lose their impact year after year. Simultaneously, traders will latch onto the narrative late in the game and lose money as equities are no longer trading based on that view. We are now entering the third year of, quote, hot inflation means stocks go lower, yet equities continue to reflect something different. Don't strain your brain trying to make sense of it all. As a trader, asset prices are all that matter. Sometimes it's as simple as, quote, folks want to buy stocks. Stocks may go up, they may go down. I really don't care. I'm just calling it how it is.
I think that's right. It's too obvious to think that every time there's an inflation number that's like sort of on the warm side, we're going to be down 400 points in the Dow. I think the market like has outsmarted that. It's too easy.
Well, it actually ended in January. Remember the chart that we showed of implied Fed funds future versus the S&P 500, and one of them was inverted, and they tracked dead even in 2023, and that relationship broke in 2024 because the expectations for rate hikes, meaning like cooler inflation, that just kept getting pushed out, and the market seemed not to care. So that narrative died in January. And listen, at the time you can't know it. It only happens after a period of time. But narratives change, and people that latch onto a dead narrative have a really hard time making money.
What's the thing? What's that saying that we both love? Just when you think you figured out the key to the market, they change the locks.
Great.
Right.
It's exactly right.
Anything that works so consistently that you could explain it to other people and then they can make money doing it, like that can't last long, which is, I think, in part why the Magnificent Seven dominance is so frustrating for people who have a long market history, because it's unprecedented for it to have gone on this long.
Well, the easy trade that's been working for 12 years has to piss off market professionals.
Big time. And actually, a sneak preview of tonight, I spoke to one today. So I spoke to Bill Smead of Smead Capital, and he thinks that the S&P is in for a 10 to 15-year period of flat performance. And he thinks that the Magnificent Seven will be the reason why. So I don't want to step too much on that, but we're going to drop that tonight on the Compound and Friends feed.
Guess what? Not a crazy take. Look at the returns over the last 15 years.
And dude, this guy's not a economist or a Twitter asshole. This guy manages real money, and he's been doing this since 1980. So it's a really interesting take. So you guys can listen to that on the podcast feed later. I want to take a little bit of a victory lap. I said this shit, and everyone laughed at me. And now it's becoming conventional, accepted wisdom. And Michael, I would like you to genuflect. I really would.
What does that mean?
I would like you to Google the term genuflect, and then I would like you to actually.
Okay, because you don't know what that word means. You're throwing around words. You don't even know what it means.
No, it means like bow down before your
I will
superiors.
fuck you. I'm not genuflecting anything. I will not genuflect.
All right, just give me some credit. I'm just kidding.
No.
BlackRock's Rick Reader.
Hold on. I'll give you credit. When you said this on the air with Jeff Gonlock, it was a Fed day. And I do remember and we love Jeff, but he gave you a that's cute. Like I think he might have chuckled. And at the time you said it, it was a pretty crazy thing to say.
But look, I said that there is now so much money in the top 10 or 20% of the wealth distribution, and what ends up happening is that those are the people who are driving the rest of the economy with their spending. Those are the people that continue to spend money to redo their house, upgrade their car, have personal trainers, on and on and on and on. And that spending is everyone else in the economy's income. And so the argument against it was, yeah, but that's not big enough to offset whatever they were saying is the thing to be bearish about. Yeah, no, it turns out that it really was. And who do you think is buying all these airline tickets and booking up all these hotels? It's the investor class. Like to me, it's as plain as day. And we talk to millionaire households. Their cash is making them more money than their stocks were making them 2 years ago, before all these rate hikes. So it's this weird thing. And this was the joke when I was like, hey, maybe the Fed needs to cut rates to calm the economy down. I wouldn't go that far, but I would say, like, you have now made it so that the 69 million baby boomers who are still alive and are now making more money than ever with no risk. And you think the economy is going to slow because of that? What are you, nuts? So that's the very real situation we're in, and it's crazy when you think about it. So I feel like I was early to this. I was saying this in November, dude. Do you remember?
Yeah, I don't really agree. I think that
I know, but the can I read what Rick Reader said?
Sure.
BlackRock's Rick Reader has some advice that bucks conventional wisdom. The best way for the Federal Reserve to temper inflation will be to lower rates, not hold them higher. That's because well-heeled Americans are earning more than they have in years from fixed income investments, given that benchmark rates remain on hold at their highest level in a generation, according to Reader. So, yeah, I mean, he sees it, and now a lot of people are talking about it. Many people are saying this.
I don't really buy it. I think that the economy is really strong, and I think that this is like a cute argument, but I think that if you have $10 million in the bank, your spending is not changing based on how much money you're earning on your cash.
And you're wrong about that. And you're wrong about that. And you're wrong.
Not.
And you don't have to have 10 million in the bank. 1 to 5 million, and whatever money you have in the bank, let's say it's 20% of that, 50% of that, the wealth effect is real on high yielding cash balances. It's no different than the wealth effect from stocks. And by the way,
I'm not a wealth
we're getting them
effect guy.
both at the same time.
I don't buy the wealth effect. I think the economy is strong, and that's why people are spending money. And the reason why people are spending money is it's the marginal spender of money. People with money are going to spend regardless. As long as there's not like a GFC, they're going to spend their money. That's what they do. They spend. The lower end consumer is making way more money than they ever have, and they're spending a lot more as a group. And I think that's moving the needle more so than people that are earning 5% in their money market.
It's two different categories of spending. I don't disagree with you, but it's two different categories of spending. I would just point out we had 0% interest rates in the wake of the GFC for a really long time, and we had disinflation. Now we have high interest rates, and it's prolonging inflation. I can't believe that that's complete coincidence.
There was so much financial anxiety surrounding the almost end of the financial world that, of course, people weren't going to spend their asses off in 2011.
Sorry, don't get mad. Dave Wilson said mudrooms for everyone. There have been, I mean, in fairness, there has been a lot of mudroom construction, and that is
So,
definitely
do you think
driving.
that I spent money in my mudroom because I'm earning 5% in my checking in my money market account? That's absurd.
I think it made it easier for you to make the decision to pull the trigger.
What?
I think, honestly, I think your mudroom was going to happen no matter what. In fairness, I think that was just destiny.
My mudroom is inevitable.
Your mudroom is inevitable. All right, go ahead. You're up.
Anyway, no. In all seriousness, credit to you because it was a crazy call at the time. And
But
now,
you don't believe in it.
No, I don't agree. It's fine.
So why am I getting credit?
Because you
Double
had the
down.
chutzpah, you had the chutzpah to say it, and now luminaries like this guy are
Wait, luminaries like this guy. Do you understand? Rick Reeder oversees the largest pool of fixed income on the planet. It's literally the fixed income chief at BlackRock.
Hold on, do I not know what that word means?
No, you do, but like, let's not downgrade him to like, oh, he's just a luminary. Here's his title.
I'm giving credit. He's a fucking monster.
Chief Investment Officer of Global Fixed Income at motherfucking BlackRock.
Dude.
Now agrees with me.
A person who inspires or influences others, a guiding light, an inspirational role model, a heroine, a leader, a legend. That's what a luminary is.
I know. So, like, I want you to agree that I'm right. It's me and Rick Reeder against you.
And Jeff Gundlach's on my side.
Maybe not still. We don't know.
I'll take my chances. I'm very confident in my assertions, Josh.
I know.
All right, let's talk about private REIT redemptions. Did you see this article?
No. Tell me about it.
So BREIT got that's Blackstone's real estate fund. So
That
BREIT
got all the press.
Got all the press. There was a lot of redemptions. They couldn't give all their money back because there's like a gate, right? You could only allow whatever it is, 5% of the money to be withdrawn a quarter because this is money that's invested in real estate. These are not liquid assets. So you can't just get your money back. That's not the way this works. So it seems like things have stabilized at BREIT. But the $10 billion fund SREIT from Starwood Capital is not doing so great. So here's the story from the Journal. In the first quarter, the fund was hit with $1.3 billion in withdrawal requests, but satisfied less than 500 million of them.
Wait, stop. It's a $10 billion fund, and in one quarter, they got hit with $1.3 billion.
It's a lot. So,
how are you going to do that?
So the Journal is saying they have three options. None of them are good. They could take on more debt, and they've already got a decent amount of debt. Not like crazy, but they could sell properties into a tough market. That's not a great solution. Or it could halt completely or limit further redemptions, a move that would greatly impair the fund's ability to raise new money. Yeah, if they do that, if they say sorry, nobody's getting their money back, they're never getting another dollar back.
You don't want to do that.
So look at chart on, please. Look at these redemptions. That's a lot of money. That is a lot of money. Again, it's only a $10 billion fund. And worse, look at the fundraising by month. So now this is where cash yields are very, very impactful. Next chart, please. It's not people spending, it's where they're allocating their money to. So in 2022, when rates were still sub 1% or whatever it was, 1.5%, 2% maybe, these real estate investments looked really attractive. Oh, I can get 11, 12%, whatever it is. Hell yeah, that sounds awesome.
Look at this. The
Well, guess
fundraising
what?
is at zero right now.
Guess what? When you could get 5% on your cash risk-free, that sounds a lot better, does it not?
I'm sorry. This is saying that in 2022, it looks like at least the first half of that year, there was like $600 to $700 million a month coming into this vehicle.
Yeah.
So what is that? Like Merrill Lynch brokers selling it to their high net worth? Where is that money coming from?
Yeah, it's probably mostly wirehouses. Now, it's not only a function of people preferring cash to things like this. It's real estate's getting crushed. So they own hundreds of properties, mostly warehouses and rental apartments in the Sun Belt.
Yeah, but what's weird about that fundraising is that everyone knew that rates were going up then. It's not like 21 when people thought it would be disinflation forever. Like by that time, inflation was 8%, and people were selling hundreds of millions worth of private REITs. It almost seems to like defy law. It's a very weird sequence of. It's a very weird anachronism that while rates were going up, brokers were piling into private REITs for their clients. That's weird shit to me.
I don't know. Well, if you pulled this chart back, I'm sure it didn't just start in 2022.
Yeah, no, that's probably true. It might have even been more.
Yeah, so people really like high income products.
Let's back up. So what are the three options that Starwood could pull here? Option one is take on more debt. What does that do? It allows them to pay money out without selling assets?
Yes. So they could take on more debt. So I think their debt levels right now are like sort of in line. It's not crazy. They can sell existing properties, but the market's depressed, so that's not a great option either. And then the third option is a non-starter, where you basically say to everybody, sorry, you're not getting your money back.
What about the fourth option, where they find someone that actually knows commercial real estate and comes in as equity, and they might have to market lower to get somebody to want to do that?
I don't know. These are smart people. They know what they're doing.
They know better than we do.
I mean,
well, apparently maybe they don't.
This guy's been around forever.
Yeah, he's a CNBC regular, the Starwood guy. What's his name? Barry Sternlicht. Yeah, he's been around forever. He'll figure it out. All right, but still, I never really understood the allure of these things. I know the interest rates that they pay.
There's no volatility.
The potential for capital appreciation, the lack of data. There is volatility. It's just not.
I should have used air quotes. You know what I mean?
Right. It looks like it's less volatile than it is because there's no quote every day, and there's a higher than average yield. But this was always going to be the risk that in a down market you're kind of stuck. Like, so if you understood that, then you can ride this out. You're not.
Now, good news is, as far as I know, they haven't cut their distributions. So
yet, next shoe to drop.
All right, what stock am I buying?
I'm going to make the case. I'm going to pitch you Corning. Michael, did you know that Corning
GLW
is one of the oldest companies in America? Corning has been around since before the Civil War. It's actually an upstate New York company, which makes sense.
Rochester?
Like in that vicinity. Part of me, I'm guessing, part of me feels like it could be in Corning, New York. I don't know. Anyway, this company was like making the shoe buckles for Paul Revere. It's 170 years they've been around. So this is one of our oldest, longest running industrial companies. And they're in a lot of verticals. They're in life sciences. They make all the displays on cell phones and computers and flat screen TVs. They're in environmental sciences, specialty materials. But the real driver of the stock is optical fiber, demand for optical fiber. So it's an industrial with a very heavy technology end market, and that's what moves the stock. Now, during the initial,
this, right? Don't they make this screen for the iPhone?
Yes, Gorilla Glass.
Gorilla Glass.
During the initial, but that's a commodity business. That's not exciting. Optical fiber is exciting. During the initial .com build out, which I was around for, this was one of the hottest stocks in the market. When I tell you, because not only was there a .com bubble, there was a telecom bubble and a telephony bubble, and there were these things called competitive local exchange carriers, or CLECs, and everybody was loaded with cash, ready to buy more and more and more and more fiber. And it turned out we really didn't need it until YouTube came along 5 years later. It was dormant or dark fiber, but this was global, and Corning was like the supplier. So this stock used to fuck, okay? It's done basically nothing for a really long time, but now technically I'm seeing a little bit of an inflection point.
I'm seeing what you're saying.
And I think that's because the hyperscalers, if they're really going to do this $2 trillion overhaul of all of their facilities to be AI capable, you need optical fiber in order for every one of these components to talk to each other. So this is going to be, it's not just broadband, it's more than broadband. Okay, so that's the story at least. The company kind of confirmed that story during their last earnings call, which I listened to on the Quarter app, by the way. Shout out to Quarter. Here's what they basically said. The carriers, which are their biggest customers, the telecom carriers, have been chock full of inventory. And as a result, this has been a depressed stock because there hasn't been that much ordering of new optical fiber, new broadband cable, et cetera. They have now worked down that inventory, and the CEO said, or might have been the CFO said, Q1 will be the low point of revenue growth, and they're talking about growing revenue by $3 billion now a year. It's a revenue base of like 12, 13 billion. So that's meaningful. And I think when you look at that gap, that was April 30th. You look at that gap, that's probably your pivot point where you want to manage risk. So this stock hit the Russo list. Sean and I are keeping this list of the best stocks in the market. Basically,
wait, what's in that? What's in that ingredient? Is it proprietary?
It's proprietary. We don't share. But I want to show you the technicals. Chart on. I'm showing you this with RSI because this is admittedly an overbought stock right now. This is an 82 RSI. This is a hot stove. I'm in this stock from a slightly lower price. I probably won't be adding with it this overbought. I will be looking for it to set up again once it cools off. But everyone's hearing that same story I just told you. It's ricocheting around Wall Street. That's why it's under accumulation like this.
Wow, it's ricocheting around Wall Street that is good.
You could see, I used to do this for a living.
By the way, hold on. The reason why you need a candlestick chart as opposed to that Fakakta line chart that you just threw up there, on the line chart, I don't see the gap. I don't see that post-earnings gap. And guess what? You know that gap's getting filled.
Yeah, I think it's important that you realize that chart came from your research group. So let's look at a 10-year Corning chart. 3620, where it's trading right now. It seems like it's up a lot off of its 2023 low, but it's really just first starting to inflect because again, it's it's a heavy industrial, and when inventories at its customers are high, it's going to be under pressure and it's not going to be delivering growth. So the fact that it looks like it wants to break out, just keep in mind, it might be short-term overbought, but it really hasn't done shit.
Yeah.
Right? Okay. Yeah. 13 years of consecutive dividend increases. Current yield is about 3%. You could see this stair-step pattern of dividend increases. It's not an aristocrat. It's an achiever. Right? Or it's almost 15 years makes it an achiever. It's almost a dividend achiever.
It's a little Lebowski urban achiever.
1.8 billion in cash. One of the longest termed debt situations in the entire S&P 500. Average maturity is like 23 years on this company's debt, so they are fine. Last thing I want to bring out here, what's going to turn the fundamentals higher? $42.5 billion coming from a government program called BEAD, Broadband Equity, Access, and Deployment. This is a 50-state program, $42.5 billion on high-speed internet access all over the country. And Corning is going to get a pretty big share of that money. The second thing I mentioned is AI. Right now, optical fiber sales are below trend. Management is indicating they will be at trend or above, which would add 40% to their revenue run rate for the optical communications unit within the company. That's their focus right now. That's where the growth will come from. AI and broadband spend will be very involved in this AI build-out. So if they're right and Q1 is the low point for revenue for the year and you have a 3% cushion here, it's not a particularly cheap stock, but it's also not crazy expensive. I think this thing could get to 50. I really like this technical setup. You got a 50-day above its 200. And so that's how I feel about it. What are your thoughts?
I like it. I think that it's overbought, which is a good thing, by the way.
How many shares can I put you down for?
I like overbought. I like overbought stocks after they pull back. So it's
That's
also at prior resistance at like the 36 level. So I would expect this thing to come in and give you a better entry, unless it doesn't.
Michael, I could appreciate you feel that there might be a better opportunity to buy the stock, but let me ask you this. Hypothetically speaking, if you're wrong and you have nothing on the books, wouldn't you agree regret will be much more powerful? And wouldn't you much prefer a situation where you have the ability to buy more later rather than miss out on it entirely?
Can I just talk to my wife before we agree to this purchase?
Look, I could appreciate that you want to speak with your wife. That's a very common reaction. I hear that all the time. However, what I also tend to hear right afterward is that it's much easier to beg for forgiveness than to ask for permission. What? All right, we could do this all day. Hey, guys, thank you so much for watching the show tonight. We're going to finish with a mystery chart from Michael. Mike?
Oh, wait.
Hit me.
Actually, no, wait, nothing. Let's on with the show. Okay, this is a sector. This is a sector chart, and the sector let's just say that over the last couple of years, there's been headlines, Josh. There's been some really bad headlines, outright dire, asking, is this the next Lehman, and of the like. Yeah, it's been that bad.
Wait, this is a stock that they were asking, is this the next Lehman?
It's a sector, and maybe I just gave it away.
Well,
how about this? In fairness,
regional
it's
banks?
not even a U.S. sector.
Oh, fuck. Oh, my. Wait, it's not a U.S. Wait, what is it? Stop. It's not a U.S. sector? What does that even mean? So are you saying it's a country?
No, it is a sector that's outside of the United States.
What? So I have to get the country and the sector?
If you want to get the chart right, yeah.
All right. Chinese technology.
Close.
Chinese
the other
internet.
one we talk about. European financials.
Okay. I knew it was one or the other.
There you go.
All right.
Remember Credit Suisse, Deutsche Bank going to zero?
Would you like me to tell you what happened here?
Sure.
The entirety of the renaissance in European financials is due to U.S. tourists going to Greece and Italy and spending trillions of dollars. Those were the biggest problem of the continent, of the financial system on the continent, was what do we do with these banks? Greece, Italy, blah, blah, blah. No problem anymore. Those countries are flush. They are enjoying some of the best economic recovery environments that they have ever seen in centuries of recorded history. And that is thanks to tourists like me flying over, spending with abandon, booking the Four Seasons, booking private transportation, going to museums, renting boats. That's the whole story. That's the whole story. You still can't go on a European vacation right now. And I think that we should get a high five for saving the European. We found a way to bail them out that wasn't an actual bailout. American tourists bailed out the European economy. So
credit to you.
You're all very welcome. All right. Hey, guys. Hey, everybody. Did you know tomorrow is Wednesday, which means first thing in the morning? Oh, here's the music. Well done, Duncan. Brand new episode of Animal Spirits starring Michael and Ben. On Thursday, we have an all-new Ask the Compound with Duncan and Ben. And then on Friday, we're back with the Compound and Friends, followed by Jill on Money Saturday. Make sure to keep it locked. The Compound loves you. Thank you for loving us back. We'll talk to you soon.